Hello, and thank you for joining us for today's webinar. For those of you who may not be familiar with Source Advisors, we have helped CPA firms and their clients maximize specialized federal and state tax incentives for more than 4 decades. We are headquartered in Fort Worth, Texas, where we collaborate with accounting firms throughout the country to bring R&D tax credit, cost segregation, LIFO, 179D, 45L, state and local tax, as well as property tax solutions to their clients. Just a few housekeeping items before I introduce our presenter today. There will be 4 polling questions throughout the presentation. You will need to answer at least 3 of the polling questions and attend at least 50 minutes of the session as measured by the presentation software to qualify for CPE. CPE certificates will be emailed to you in the next 3 business days. Please utilize both the chat and Q&A functionality, which are located in the upper right-hand corner throughout the presentation. However, if you have a specific question for the speaker, please make certain to use the Q&A function so that we may answer them at the end of the presentation, with which there should be sufficient time. If not, we will make certain to catch up with you afterwards. Additionally, you can now download today's PDF presentation now. Finally, I'm happy to introduce our speaker today, who is Candace Orr. Candace is a Senior Director of Fixed Asset Consulting Group at Source Advisors, where she oversees tangible property regulations, fixed asset reviews, and performs tax reviews and report certifications for cost segregation and TPR studies. She has more than 20 years experience specializing in the field of fixed assets. And with that, I will hand it over to Candace.
Thank you, Anne, for that introduction. Thanks, everyone, for attending today. Hope you all are having a wonderful day. We're going to go ahead and get started. So our agenda today, we're going to do an overview of the tangible property regulations. We're going to discuss the safe harbors related to those tangible property regs, the unit of property, major component and substantial structural part. We'll talk about the repair versus improvement test, the bar test, and then we'll go into a little bit on the dispositions. If we have time, we do have a little slide to kind of do a brief discussion about the One Big Beautiful Bill Act and how it really affects the bonus depreciation. There's me, so we can skip that. Okay, so why do we discuss the TPRs? For one, not all capital expenditures are eligible for bonus depreciation or Section 179 expensing. Doing the tangible property regulations allows clients to accelerate those assets through repair and maintenance or other safe harbors that normally is not eligible on certain capital expenditures. Like 39-year property or 27.5-year property. Cost treated as a repair expense instead of a depreciable asset avoids depreciation recapture upon the sale of the property. And most IRS Form 3115s filed in 2014 to adopt the regulations have now passed. So those eligibility rules now allow for automatic changes again on certain assets that you may have filed a 3115 form on just to adopt the regs. So now you can look at them and maybe find some additional tax benefits. Polling question number 1.
All right, why discuss the TPRs? A is state tax nonconformity for bonus depreciation. B is ineligibility of some expenditures for 179D. C, to avoid depreciation recapture. D, all of the above. Or E, not applicable. Once again, you do need to respond to 3 of 4 polling questions and stay on the webinar for 50 minutes in order to receive CPE. It looks as though D, all the above, is the answer. Is that correct?
Yes.
All right, we can move on.
So the tangible property regs, the final version was released in September of 2013. Prior to that date, we operated under the proposed regulations, which define the unit of property as the entire building. Several firms, the IRS was filing very aggressive 481 adjustments. So they decided to go ahead and tackle and release the final regs. And so that's what we have been operating under since January 1st, 2014. These regs included how to treat transaction cost, otherwise facilitative cost. It discussed the routine maintenance safe harbors, included materials and supplies. It included expensing under the de minimis safe harbor. It defined the unit of property, and it introduced a bar test for improvement cost on how we can determine what should be capitalized as a betterment or could be expensed as repair and maintenance. This is just kind of a general overview of the items that were also included in the material and supplies, again, de minimis safe harbor, the repairs, and then GEA election in the order you kind of apply your expenditures. So the first safe harbor is the routine maintenance safe harbor. So these are your maintenance items that keep your asset in its ordinarily and efficient operating conditions. For non-building routine maintenance safe harbors, uh, the taxpayer is expected to have performed the activity more than once during the unit property's class life. And that class life is generally in the alternative depreciation system. So if you're in the manufacturing world and you're replacing a belt on a conveyor, you were expected to replace that more than once in a 12-year period. um, Building routine maintenance safe harbor. These are activities that are expected to be performed more than once in a 10-year period, beginning when the unit property is placed in service by the taxpayer. So if you construct or acquire a building and you have to replace the roof, you would have to expect to, replace a component or a minor component or do something within a, 10-year period. Generally, the items or activities related to routine maintenance safe harbor are inspections, cleaning, testing, and the replacement of parts of the unit of property with a comparable or commercially available part and reasonable replacement parts. And these are general kind of minor replacements, a few shingles or maybe some coils or freon in your HVAC. So when you think of routine maintenance, things that you routinely do. The small taxpayer safe harbor. This is an election not to capitalize repairs, maintenance, or improvements. This is uh, a annual election, and it's irrevocable. The taxpayer has to do a calculation where they average their three average gross receipts, and they cannot exceed $10 million. And it is on a owned or leased building with cost less than $1 million, and the cost cannot exceed the lesser of 2% of the unadjusted basis of the building or $10,000. The de minimis safe harbor election. This is an annual election as well. This is to elect to apply the de minimis to deduct amounts paid to or acquire produced property as a taxpayer does for financial accounting and book purposes. Property costing less than a specified dollar amount or property with a useful life of 12 months or less. If a taxpayer has an applicable financial statement, they must have a written accounting policy in place at the beginning of the taxable year, and that amount cannot exceed $5,000 per invoice per item. So you have to be able to have an invoice that either shows that quantity and that cost breakout, that unit cost, to substantiate that. If it's more than, say, you have furniture that you've bought in a lump sum and it's $25,000 and each piece of equipment is less than 2,000, your invoice has to show that quantity. It can't be a lump sum contract. If the taxpayer does not have an applicable financial statement, then the policy has to be in place in the beginning of the taxable year and has to be consistent with the taxpayer's books and records. The amount does not exceed $2,500 per invoice. That was as of January 1st, 2016. Originally, it was 500, but they did increase it. This was to, reduce the burden of the taxpayers going through every single item on their general ledger to determine what is capital versus expense, or as they're paying invoices. Um, it does not include amounts paid for land or rotatable, temporary, or stand emergency spare parts. Another thing is to recall is it has to be property, so it can't be things like you're painting a wall, or things that are intangible. So it has to be something that's personal property. Think of movable FF&E, HVACs, things that actually are tangible. Polling question number 2.
All right. What are examples of routine maintenance? A, inspections, B, cleaning, C, testing, D, all of the above, and E, not applicable. Let's wait for some of the answers to roll in. And right off the bat, it looks as if D, all of the above, is the favorite.
Will be correct.
Great. And I think we can move forward.
So underneath the regs, prior under the proposed regs, your unit of property was the building, the entire building. So when I've been doing repair studies, or these before they called them the final TPR regs, since 2009. So prior to that, we would test the expenditures and test the renovations against the entire building. The larger unit of property you have, the more you can substantiate under expensing. So what the tangible property regs did is that it decided that the unit of property, that the smaller of unit of property, the more likely the cost incurred for the unit of property will have to be capitalized. So they they decided that here's your building structure and your building system, and then gave us each one of the building systems and defined those in the regulations. So uh, there are 10 tests that are applied to each building system, and if the cost is a capital expenditure for the building system, it will be treated as an improvement to the entire building. So for the building unit of property, each building and its structure components is generally one unit of property. So amounts treated as paid for an improvement to the building if they improve the building structure or any designated building system must be capitalized. For non-building unit property, think your tenant improvements, where you're the tenant, not the owner, condos, plant assets, land improvements. These are all components that are functionally independent that comprise a single unit of property. So each functional independent, if you have to look at each item or each component and determine if it's functionally independent. And if it is, then it has to be placed in service. So the unit properties that were defined underneath the regulations are your HVAC systems, and those major components can include your air handling units, boilers, condensing units, fans, furnaces, heat exchangers, heat pumps, etc. The second system is your plumbing, which is your bathtubs, piping, pumps, sinks, toilets, urinals. Electrical, your generators, light fixtures, panels, elevators, and escalators are separate as well. Uh, that's your cables, your pulleys, all your control systems, your fire protection alarm, security for your building. If it's there to protect the property, your personal property, then that's your 1245 personal. But if it's there for security of the building, your alarm systems, access systems, building management systems, those type of items are 1250 property, and so it would be included in that security. And then your gas distribution systems that are 1250 property. Again, your non-building unit of properties or your plant property, your network assets, leased non-building property. Building unit of properties are your building structure, your condos, leased buildings, and portions of buildings. So a major component in the substantial structural part, the way it is defined is a major component is part or a combination of parts that performs a discrete and critical function in the operation of the unit of property. And so the building's major components may include, say, all windows, all doors, and the roof, Whereas the HVAC system, the major components may include your rooftop units and your boilers, or your electrical system, your major components may be your electrical panels, your lighting fixtures, any of the conduit and wire. So you look at each one of those those major components in relation to the system or in relation to the building structure. A substantial structural part is defined as a part or combination of parts that combine or comprise a large portion of the physical structure of the unit of property. So again, your facade, your windows, you're looking at the big structural componential part. So you have a roof, but that roof is made up of, your membrane. Then it has your structural beams and insulation. All of those are part of the building structure. And the entire roof is a major component, and then there's a structural part of that component. Um, there is no bright line test for determining major components. The regulations is about 256 odd pages, and it provides varying examples of different type of improvements and whether it's a restoration or whether it's a betterment, but there's still no bright line test. The examples show that you could have a replacement of 30 to 40% of a major component, but it's not very consistent through the type of system it is, and so there's still a lot of kind of subjectiveness in that. Multi-year projects must be considered in their totality. So if you're a hotel owner and you are doing a PIP or a property improvement plan that you're phasing out over by floor, we have to look at that as in its totality. So if how is that? Are you replacing all major components with the buildings, with the plumbing system or electrical system? If you're replacing 30 to 40% of a major component in 1 year, may be okay. But if it's a precursor to replacing more or all major components over multiple years, it could constitute a replacement of that major component. It must be capitalized. So if you have a planned HVAC to replace all your HVAC units in all your multifamily buildings over the next year and a half, then that could constitute a planned rehabilitation, and you would have to capitalize all those assets. Um, Again, the tangible property regs and how they apply, it's all facts and based. It's all facts and circumstances based. So knowing what the intent is and having as much knowledge behind it helps you better classify and apply the proper tax treatments. Um, so repairs versus improvements. So part of it is when you're looking at your expenditures and your renovation cost, once you've determined that you may not meet the safe harbors, your next test is to go through your repair versus improvement test. And so with your expensing, we look at that under section 162 expense that provides us that guidance on how to deduct ordinary and necessary expenses related to your trade or business. What are the materials and supplies? Those are usually less than $200 and used up in a 12-month period, which if you're electing the de minimis safe harbor, then the materials and supplies falls along with the de minimis safe harbor. And then you have repair and maintenance. So that's all under section 162. Um, section 263, pardon me, is related to how we must capitalize asset based on, what is paid and how it's paid to acquire, produce, or improve that tangible property and all the costs that are associated with that improvement. Um, and the benefits that extend beyond the current year. Also, if it adds value, prolongs life, or adapts the property, those are all kind of what is subject to capitalization. So this is a kind of a cheat sheet kind of table that we use to kind of flow the tangible property regs. So in order for you to expense an item, you have to apply those expenditures to apply the test to that expenditure. So each one of these tests you have to apply against that expenditure. And if you say no, then you can expense it. But if you say yes at any one point, you must capitalize it. So the three categories you have: adaptation, which is you adapt the unit of property to a new or different use; the betterment of the unit of property. There's three tests related to this section, and it is: does the expenditure materially um, correct like a material defect or condition that existed at the time of the property? So that's amelioration. Did you increase the square footage or add to that existing property? So did you expand the square footage? Did you add a mezzanine that wasn't there before? Did you add new bathrooms? So, if you add an adaptation, then you'd have to capitalize. Did you increase the quality, capacity, productivity, efficiency of the asset, of the unit of property? If so, then you have to capitalize. Restoration, there's 6 tests under this section, and that is: did you replace, when you replace the cost, did you recognize a disposition or a loss on the original asset? So did you take a disposition on the original asset? If you did, you have to capitalize. You can't expense that expenditure, the replacement expenditure. Was there a gain or loss on the sale of a component for that unit of property? Was there a base adjustment as a result of a casualty loss? So did you experience a fire or a tornado or a hurricane where you took in proceeds from the insurance company? And you can't expense assets related to that repairs or improvements. Did you return the former? Did you return the equipment or the asset to a uh, that was no longer working to a working condition? Did you rebuild the property to like new conditions? So did you rebuild an entire engine and now it works more efficiently, more and has more capacity, more production? Did you replace a major component or substantial structural part? That's did you replace more than 20% or 30% of the unit of property? If you answer yes to all these, then or yes to any of these, you have to capitalize. If you say no, you expense. Polling question number 3.
Okay, which is not a building system for repairs? A is plumbing, B is electrical, C is roof, D is all the above are building systems. Give it a second here. Once again, please respond to 3 of 4 polling questions in order to be eligible for CPE. Looks like the majority are saying D, all of the above are building systems.
It's
And we can,
actually roof. Roof is a structural component of the building structure, so it's not an actual building system.
great, thank you. We can move forward.
Okay. So the first category, adaptation. So this is an amount paid to adapt the unit of property to a new or different use if the adaptation is not consistent with the taxpayer's ordinary use of the unit of property at the time it was originally placed in service. So if you acquire a building and it was a manufacturing plant and you convert it to a showroom space, that is going to be a new or different use. You develop land used for a manufacturing plant as a residential housing, or you have a retail drugstore, you convert an area of the pharmacy to a walk-in clinic. All of those would be a new and different use, so all costs associated with that improvement would need to be capitalized. Not a new or different use. You have a shopping center that has 3 leased retail spaces and you convert it into 1 leased retail space. That is not a new or different use. You're still using it to lease out retail space for your trade or business. Preparing a building for sale. So you go in and you just perform some minor refreshes and some aesthetic improvements to get it ready for sale. That is not a new or different use. Or if you're a hospital, modifies an emergency room to provide outpatient surgery clinic, you're still a hospital, you're still providing services. That's not going to be a new or different use. What we're currently seeing in um, currently seeing a lot of is conversions of existing hotels into multifamily properties. Those a studio apartment, those are going to be a newer, different use. Or if you do a bank to daycare, those type of things, those are going to be a newer, different use, and the items will have to be capitalized. Betterment. So here are some examples between what would be capitalized cost and what would be deductible repair cost. Amelioration of a pre-existing condition or defect. So if you remediate land for contamination from leaks in the underground gas lanes for storage, that is an example one. So each one of these charts are examples directly from the regulations and kind of what we refer to when we're looking at expenditures. But so for the remediation of land, then that is a capitalized cost. However, if you are renovating a building and you come across some asbestos, you have it tested, it is asbestos, you have to abate it, that is actually deductible as a repair cost. If you have an addition, enlargement, or expansion, so you add a stairway or mezzanine, this is example 19, then you will have to capitalize that. However, if you just remove a drop ceiling and repaint the original ceiling, that can be deductible as a repair cost. If you materially increase the quality, capacity, productivity, strength, and efficiency, such as reducing energy costs by adding new insulation, you will have to capitalize. Another one in this area that we see a lot is converting your T8 lighting to the new to LED lighting. Though we're kind of getting several years out now from T8 lighting, but that is going to be a capitalized cost to convert that T8 to LEDs. Not a material increase in the quantity, capacity, productivity, strength, or efficiency is if you replace 2 of 10 mounted HVAC units. Your unit of property there is your HVAC system. So replacing 2 of 10 is less than 30%, and therefore you can expense. Some other examples. So if your real property is a standalone restaurant and you refinish the wood floors, that unit of property's building and structure, you can expense that. If you're a restaurant shopping mall that's in a leased space and you replace water piping in a kitchen, the leased portion of the building is of the building's plumbing system. That's going to be expensed. If you're a retail store that you're owned and you replace all your RTU HVAC units, that's going to be a capital event. If you're a retail store that's leased and you just paint the exterior of the building, you're looking at the lease portion of the building structure. That's going to be an expense activity. If you're a manufacturing plant and you've relocated and replaced some lighting expenditures or lighting fixtures, that's going to be a part of your building structure, and that's going to that actually should say electrical. I don't know what that says, building structure, but that should be your your electrical system. Your manufacturing plant, your replacement of the entire roof, including the decking, so it's open to the sky, that's going to be a building structure, and that's going to be capital. Underneath the regs, they provide a section, example 6 under the betterment rules, for example 6, 7, and 8, that talks about remodel. There was also separate regulation that was released under section or regulation 2015-56 that was a safe harbor for retail and restaurant. We don't go into that in this discussion, but this is primarily, you have a building and you're going to do a minor refresh, kind of a splash and dash is kind of what we call it in the industry. And that kind of consists of, just cosmetic layouts to change the store's interior, to do some general repairs and maintenance, to modernize the building. So within this example and the regs, it says that, if you replace, configure the display tables and racks and moving the walls, you relocate some lighting, you're repairing some floors, you're repainting, you're patching, you're cleaning, power washing the exterior. All those are refresh activities and not a betterment to the building. Example 7 is your building refresh, plus you have a limited improvement. So you are also going to increase the building's footprint by constructing a new loading dock and adding a second overhead door. You're going to upgrade the electrical system to provide lighting and power to the space. So those activities that are related to example 6 under the refresh, you can continue to expense those. However, those costs associated with the addition and the electrical betterment, those are going to have to be capitalized in accordance with 263A. Now, example 8 is your major remodel. So you assume all facts in 7, 6 and 7, plus you're replacing exterior walls with windows, you're rebuilding and removing the facade, you're replacing vinyl flooring with ceramic tile. All of these are, replacing major structural parts in addition to adding the additional mezzanine and those items, or the dock and those items. So the physical nature of the work and all of the effects to the building structure results in a betterment. So everything has to be capitalized at that point. Restoration. So the restoration is where we kind of get into the replacement of major components or a substantial structural part. So again, these are examples that come straight from the regulations. Sorry, unit property is a roof. The example they give for it is not a is a restoration, is if you replace the entire roof, decking, insulation. That's example 14. Under example 15, if you replace just the roof water membrane with a like kind membrane, then you can expense that. So a good way of looking at it is if you're not opening up to the sky and you're just replacing the same roofing system with like kind comparable system, then you'll be able to expense that. But as soon as you remove that roof and you remove that decking and it's open to the sky, you're going to have to capitalize it. Under HVAC, your unit of property, you replace the chiller. In the office HVAC system consists of one chiller, one boiler, pump, ductwork, diffusers. That chiller is a major substantial part of that HVAC system. And so you would have to capitalize that HVAC. However, um, if what is not a restoration is if you replace one furnace and that system consists of 3 furnaces. So you're only replacing 30% of the furnaces of that substantial structural part. So they say you can expense that. Or you replace 3 of 10 units of the HVAC system. There again in the example, it's kind of like the 30% kind of threshold. And so that's kind of what we look at. How many units does the building have? How much are they replacing? For your electrical system, if you replace wiring throughout the building to meet code, then you have to capitalize. However, if you're replacing 30% of the wiring to meet building code, then you can expense that. Same with your plumbing system. If your retail business replaces all the plumbing fixtures and all the restrooms throughout the building, you're going to have to capitalize that. But if you replace 8 out of 20 sinks in the restroom, that's not a capital event. Building structure, hotel's a good one here that they use as example. So if you replace all the bathtub sinks in the hotel room, and 4 of the 20 floors, then that's going to be a capital. But if you do a hotel renovation and maybe you're just resurfacing the tubs and you're only replacing the sinks, but the toilet and the rest of the stuff stays throughout the building, then that would be more repair in nature. Building structure, there's a windows and they talk about flooring. Again, a lot of it is how much percentage of you are you replacing and how much of it makes up, that particular component. So again, everything's very facts and based circumstances when you're walking through your expenditures. Typical qualifying repair and maintenance deductible expenditures. These are ones that we see a lot of times with our non-building property. So for personal property, typically replacement of any Section 1245 property is required to be capitalized. With the exception if you are refinishing, relocating, reinstalling property to be expense. So a lot of times you'll see these in our multifamily properties where you may be just refinishing, repainting your cabinetry, in some cases, and or maybe replacing just a small portion of your LVT flooring. Then those might be more of a expense in nature. For land improvements, any type of restriping, repaving, minor repairs to sidewalk or curbing, removal of landscaping. So kind of think of your seasonal. You change out your flowers, your annual flowers, and you might do some sprinkler repairs. That type of thing would be an expense activity. Any kind of pool resurfacing, miscellaneous pool repairs, those type of items, you would be able to expense. Some special rules, cost incurred during an improvement. So if the expenditure directly benefits or was incurred by reason of another capital activity, then the cost must be capitalized. So all your indirect soft costs for architect fees, any kind of trash removal, any of those type of items that are directly related to the construction also must be capitalized. Typically they're on a pro rata basis, but you do have to include those. So just when you're looking at your renovation cost, you'll want to make sure that you're including everything that was directly related to it. Removal cost. If a taxpayer disposes of a depreciable asset, including a partial disposition, and has considered the adjusted basis of the asset or component of the asset and realizing a gain or loss, the cost of removing the asset or component are not required to be capitalized. So those selective demolition costs are those costs related to, say, removing carpet or removing the electrical panels for what you're replacing. If you're taking a disposition on the original asset, then you'll be able to take those costs as a demolition cost. Otherwise, if you have not taken a disposition, then that would become an allocable indirect. Um, you can also elect to capitalize expenditures for repair and maintenance costs. So remember, everyone was supposed to adopt the regulations in 2014, and so the taxpayers are supposed to be following, and looking at their expenditures and determining what's capital and expense. So um, but if you decide that you no longer want to do that and you want to capitalize everything, you can do that, but you have to elect to do it. All right, to the fun stuff. Dispositions. So this was new. This was under a separate regulation, but it goes hand in hand with the tangible property reg. So prior to uh, the passing of the partial asset dispositions, you could not take a retirement from a building asset. So you could have 3, 4, 5, 6 roofs on a building because you couldn't take a partial asset disposition. And a lot of times you would just capitalize it because it might have been a betterment. So with the partial asset dispositions, it does now, or the disposition rules, allows us to write off that part of that building. So a disposition is a transfer of ownership of an asset or the permanent withdrawal of an asset from the business through seller exchange, retirement, physical abandonment, destruction, transfer of supplies, scrap, or similar account, retirement of a structural component of a building, that's your partial asset dispositions, or involuntary conversion. Disposition regs apply to the single asset accounting, multi-asset accounting, and general asset accounting rules. Dispositions of entire assets are not elective. So if you've done a cost segregation study and you have componentized your assets and you dispose of that assets, it's not an election. You should take that disposition. Partial dispositions, however, are elective, and they are, however, required in cases of casual events, step and shoes transactions, gains not recognized under Section 1031 or Section 1033, or a sale of a portion of an asset. To identify your dispositions, the regulations require taxpayers to use any reasonable method to determine disposed assets in a GAA or a MAA or a portions of a larger asset. The choice of a reasonable method is an accounting method election. Some of the examples of a reasonable method would be to discount the cost of the replacement asset, so to its place in service date using the producer price index, You could do a pro rata allocation of the unadjusted depreciable basis based on the replacement cost of the disposed asset. You could use a cost segregation study. With at Source Advisors, we do what's called an enhanced cost segregation study. Your basic cost segregation breaks out your 1245 and your 1250 land improvement. What an enhanced cost segregation does is it breaks out that 1250 building property into those components that you need within each of those building structures and building systems so that you can take a partial asset disposition when you decide to renovate your property. This is reported on your Form 4797 and the year the property is removed and disposed of from the property. So it's very important that if you know that you're going to start demolition, and what tax year you're going to do that disposition. So if you're crossing over years and the demo happens in 2025, but your renovations won't be completed in 26, then you want to make sure that you're identifying those dispositions and taking them in 2025. You can't retroactively go back and take those dispositions. So Section 280B, this is where it's actually, your renovation cost. If your demolition is 75% or more of the existing external walls, or 75% more of the internal structure, then that's not a renovation. That's going to be considered demolition. And so the adjusted basis of that demolition or disposition has to be go to land. And then the demolition cost also has to go to land. So when you're evaluating this, you need to determine, how much of my external walls and internal structural framework are retaining in place, to determine whether or not you are in violation of 280B, or whether you can continue on as a renovation and do expensing and capitalization and partial asset dispositions. Your dispositions, they are done on a timely filed return for the year the building is placed in service. A taxpayer can elect to place a single building into a general asset account. Generally, you cannot take a pad for assets in a general asset account, so you have to wait until you actually dispose of the building completely. If a taxpayer intends on to demolish a building a few years after acquisition, they should you might consider electing a GAA status for that building. That has to be done at the time of acquisition in the year that it was acquired. You can't go back and elect a GAA. The GAA election is a big part, is the main part of Rev Proc 2015-16 for the remodel, refresh safe harbor, to do your 75%, 25% split. So you may have some restaurants owners that and retails that may want to do the GAA election on that building. You just have to every improvement that's 1250 property ends up having to go into that GAA. So it's a little bit more complicated. So that's about it. Polling question number 4.
All right. Have you filed TPR related 3115 since 2015? A is yes, B is no, C is I never filed them, and D is not applicable. Candace, we also have 2 questions,
Yep.
but would you like me to read them?
Oh, sure.
Or we can address them at the end?
We can address them then. We don't have too many slides left, so.
Okay, terrific. We will do that. And it looks like, split between yes, no, and I never filed them.
All right.
And we can move forward.
So, the One Big Beautiful Bill Act, I just wanted to touch on bonus depreciation a little bit because it is, most recent. And so this is a table, but so the one bit of big beautiful bill, I guess they're calling it OB3. Um, it had made 100% bonus depreciation permanent, beginning after 1/19/2025. Some things to consider is that if you acquire a property, there is still the written binding contract that you have to look at to determine whether or not it is eligible for the 100% bonus. So if you do not have a written binding contract, um, then before that date, before 1/19/2020, or sorry, yeah, after 1/19/2025, then you have to apply bonus depreciation based on the Tax Cut Jobs Act. Um, if Same with there's also the safe harbor for renovation or self-constructed property. If you have incurred more than 10% of hard costs the before 1/19/2025, then you will also revert back to the Tax Cut Jobs Act. So we look at those items when we're looking to see what kind of applicability of bonuses. And so they didn't make it retroactive to, back to 2024 when bonus, or 2022 when bonus, went to 80%. So, we're moving forward as far as January 20th, 2025 on those 100% bonus depreciation. So I think we have one more. That's it. All right. So we can answer some questions.
All right, just a moment. The first one is, no, excuse me, what if a roof replacement is less than 30% of the building?
So because the regs do not actually have an example of um, if there's a portion of an entire roof replaced, so if we're removing the decking and it's less than 30%, it doesn't really give us that guideline. And there hasn't been many, at least, as part of us that are part of the American Society of Cost Sec Professionals, in talking with our colleagues within that organization, there have not been too many repair studies or tangible property studies that have gone to audit. And that's included, I mean, since the stand down. So it's, been several years. And so that one's kind of on the gray line area, no bright line test. So I think that you weigh, John, how risk adverse you are, 30%, 40%. But if it's removing, all the way the decking, the plumbing, I think I would probably say that it would need to be capitalized and then take the partial asset disposition. It's a more conservative approach than taking the whole. But I think I would lean more towards taking it as a capital event.
Great. And the next question is, can you mention timing for PADs, PADS, and expensing versus capitalizing after
Yeah.
first year of ownership?
Yeah. So generally, industry-wide, again, the regs, there's not really a bright line test, but in most cases and instances, they say in year 2. And so after acquisition, in order to take partial asset dispositions and repairs and expensing, you'll need to own the building for at least a year. Otherwise, you fall into the amelioration clause. So you did not incur the wear and tear on those assets that you're replacing. So you acquire a building and you have a property condition report that tells you need to replace the roof because it's been leaking and ceilings you have drywall falling down and all those items. Then that's going to kind of, the intent on that is that you're fixing it due to other people's wear and tear and you fall in that amelioration. So you would need to capitalize that. And you can't take a disposition and an acquisition in the same year. So the assets that you have in the building at acquisition, if you're going to immediately remove them, then you're telling the IRS they had no value. And so therefore we don't take partial asset dispositions in the first year. You can do expensing for your not routine maintenance safe harbor, for your de minimis safe harbor election. So if you're a hotel owner, a big thing is, all the movable FF&E that you've purchased, all the OS&E that you've purchased, a lot of those are underneath the 1 year life or are less than $5,000 or $2,500, and you can, expense them. So you can, get a pretty large benefit out of analyzing those costs.
Great, thank you. That was the last question, and unless anybody, okay, we have one more question that just came in. On the last point about the date of the binding written contract, the date of the contract indicates which 179 rules apply, not the date completed, date in service.
The date of the contract indicates which 79 rules apply. Not really sure about that one. I'd have to look on that one and get back with tax, because it's pretty much following the same rules underneath the Jobs Cut and Tax Act, where it provides us with not only the 10% or the binding contract rules, but it's also the what makes it binding. So there's like a percentage in there, and I don't remember what section it is offhand, but how much liability I think or waiver that's within that. Sorry, Mark. I'll get back to you on that.
All right, unless there is another question that pops up, I think we are all set. Thank you so much, Candace. Do you have any last remarks?
No, I appreciate all of y'all attending our webinar. And if you have any questions, please feel free to reach out to myself, or if you're already in contact with one of our business developers, you can reach out to them and they will reach out to one of us on the technical side. Oh, there was another one that came over. What are the significant multiple MAA and GAA? Your GAA is your election that you have to make. It's a general asset account. The building stays in there until it retires. Your multiple asset accounts, think of them as you have all your assets separately stated on your depreciation schedule.
Great, and that looks like it's the last question, so thank you so much. If you are eligible for CPE, you should receive those certificates within the next 3 business days. Thank you for joining us, and thank you again, Candace.
Thank you so much.